So it's an honor to be here. I want to thank you. I'll introduce myself. I'm a funny little nerd. I like to study trading. I'm a very specialized type of economist, a financial economist. So I study the nuts and bolts details of how markets operate. I've been to over 50 stock exchanges around the world, and I love to sit on trading desks and actually try to understand trading. Now, there are basically four arguments for transactions tax. First one says, well, there's too much socially useless trading. All those traders, they're not doing anything useful, so we should tax it like we should any other sin like alcohol or something else. Second of all, they'll say, ooh, not only is it not useful, it adds to volatility, and so if we reduce the trading, we'll reduce volatility, and we'll all live happily ever after. The third argument basically says, Wall Street bleeped us, so let's bleep Wall Street. And the fourth argument is, hey, yeah, it's got distortions like any other tax, but the government needs the money for a lot of really good things, so this is an easy pot of money to grab. So let me deal with these four basic arguments. The first basic argument says, well, all this trading is useless. Not so. The problem with the transaction tax is that it's going to hit the beneficial trading far harder than it is the harmful trading. And I will admit, there is some harmful trading, but the highest frequency traders are actually doing things that help the market. And I could give long, long lectures, as I do in my World Equity Markets course, on exactly how this works, but let me give you a real brief example. That a large part of what the high-frequency traders do is arbitrage. That is, when you have two related securities that should have the same price, but they start to differ because of noise in the marketplace. For example, how many of you have ever heard of an exchange-traded fund, an ETF? Okay, it's a very popular retail financial product. What it is, it's basically a single stock that represents a basket of underlying stocks. So if you wanted to invest in every stock in the Standard & Poor's 500 index, you could buy an exchange-traded fund, like the Vanguard Vipers, that track that index. Now, it's a very popular mom-and-pop retail investment vehicle. And it has very, very low fees, very efficient. But how do you know the price of that ETF actually tracks the underlying stocks? You depend on the market to do that. And what happens is there is an ecosystem of traders who watch the price of that ETF, and they watch the price of the 500 stocks that go into it. And when it gets a little out of line, what they'll do is they'll buy whatever's cheap, sell whatever's expensive, and they'll push the prices back into line. Now, they don't really intend to hold on to that ETF forever. No. All they're trying to do is to push it back in line, and if they're lucky, they may make a penny, but on average, these high-frequency traders make less than 1/10 of a penny per share. But they are providing a valuable service in keeping security prices in their proper alignment. So these are the people who would be hit hardest by such a tax. Now, the speculators and the gamblers that you're trying to get at here, they're not the high-frequency traders. The person who's listening to vibrations from the planet Mars telling them that Dog Meat Inc. is going to double, they're not going to be deterred by a tax. It's the people who are doing these beneficial things, they're the ones who are going to be hit hardest. Now, we all have a lot of anger over what happened in the last 2 years in our financial markets, but we've got to remember that our financial markets are not one big monolith, that the trading community is one small part of our entire financial services infrastructure. And just taxing trading is not going to punish the people who caused all the problems. It's not going to punish the people who made those subprime mortgages. It's not going to punish, the folks who repackaged them and sold them. It's not going to punish the folks who misrated them. So a transaction tax is not going to punish the folks who caused the recent meltdown. Now, as far as the revenue goes, the proponents are trying to have it both ways. They're saying, oh, you're not going to notice it, but oh yeah, we'll get over $100 billion a year for the government. $100 billion a year is noticeable. It's a major tax. And so rather than thinking, oh, it's a painless thing that is not going to hurt anybody, that level of tax is going to cause major distortions. So let's look at this through the lens of good tax policy. I'll be the first to admit the government needs the money for a lot of worthwhile deficit reduction and other activities. Okay? So if we're talking about climate change, whoops, only one last minute, let's tax carbon directly. I mean, that would do a lot more for climate change than taxing trading. I would like to, I've got 1 minute left. Let's see, I basically pointed out we're going to punish good trading more than bad trading. This will not punish the guilty. It is bad tax policy. I'm glad that the proponents pointed out that we got rid of these taxes before. That, you know, Japan has gotten rid of it, Sweden's gotten rid of it. You know, all these countries try it, it looks great from a distance, and then when they get into the details, they go, yuck. In 1965, an overwhelming bipartisan majority in Congress voted to get rid of the old transaction tax because they realized that it was just bad tax policy. You know, and this was at a time, it was a year after the Kennedy tax cuts, it was at a time when they were aware of the revenue needs of the Vietnam War, and they still realized this is a bad tax. The proposed DeFazio-Harkins tax is much, much bigger than the old tax. You know, the old tax was much, much smaller. I don't have the number in front of me. My time is almost up here. But on a 100-share trade for a $50 stock, the DeFazio-Harkin tax would be a $12.50 tax on that trade. Now, right now, commissions are, depending on which broker you go to, $5 to $10. So we're talking about essentially doubling the trading costs. On top of that, we're going to increase other indirect transaction costs called the bid-ask spread. So there are better ways to raise the revenue. This tax isn't going to do anything of the good things that the proponents say it's going to do. Thanks.
My name's Gus Sauter, and I'm very pleased to be here today. I want to thank the group for inviting me here. I'd like to follow up on some of the stated intentions of a couple of the bills that have been proposed. One has been to have Wall Street pay this tax, and the other has been to have very negligible impact on individual investors. Unfortunately, I don't think either one of those will be accomplished by this tax. Let's take a look at the individual investor to begin with, following up on what Jim said, and the costs that the individual investor will bear. Now, certain investors are going to be, in various proposals, are exempt from this tax. Those that are in retirement accounts, such as 401k plans, such as defined benefit plans, IRAs. That's if they invest directly in the marketplace. They will not have to pay this tax. However, many retirement plans actually invest through mutual funds. Mutual funds have been a very growing part of the investment community over the last 5 decades, whereby most individuals actually get their exposure to stocks and other investments through mutual funds nowadays, not directly in the markets themselves. So what happens to mutual funds? Mutual funds would be subject to this tax. So an investor, although they wouldn't pay the tax directly, they're going to pay it through their investment in a mutual fund. And let's take a look at the size of this. I'll simplify things and just take a look at equity mutual funds and say there are 2 types of equity mutual funds: index funds, passive funds, if you will, and then there are active funds. So let's look at them each separately. An index fund is essentially a buy and hold investment. You invest in a market or a segment of the market, and you basically hold that for forever. There is some trading involved in an index fund because the market itself changes, so you have to change the index fund periodically. As the index fund has to sell a stock that no longer remains in its index and has to buy a stock, it's going to pay this transaction tax. The tax itself is 0.25 on the sell and another 0.25 on the buy. Let's just say an average index fund has 10% turnover a year. If you run through the math, a 0.25% tax on the sell and a 0.25% tax on the buy times 10% turnover, that's 0.05% transaction tax the mutual fund will pay, and therefore everybody who invests in the mutual fund is paying this every single year, otherwise known as 5 basis points. So that's the first order impact of this transaction tax. Unfortunately, there's a second order impact that's even far larger than this. Actually, it's about double what the first order impact. And Jim was starting to describe that. The transaction costs that mutual funds pay will actually go up. But Jim was describing the brokerage commissions, the bid-offer spread, the market impact that you have. These are transaction costs that aren't really directly measurable. We can estimate them. We can't know exactly what they are. You'll never see them in your prospectus. You have to really study very very diligently to try to figure out what transaction costs are. Well, transaction costs have declined quite dramatically in the last decade because there have been a number of changes in the marketplace itself, a number of changes introduced by the SEC, and it's been very beneficial to investors. We believe transaction costs have been cut in half, from about 1.1% on the average transaction to less than 0.5% on the average transaction. Significant savings to investors as their mutual funds invest for them. If we go back, if we impose this tax, well, then the people who are making the markets efficient, as Jim described, through arbitrage and making these transaction costs much lower, they'll disappear from the marketplace, and our transaction costs will go back to where they were a decade ago, or 2 decades ago, or 3. And we're looking at significantly higher transaction costs, at least 0.5%. Well, 0.5% may not sound like a lot, but if you multiply that by the amount of activity that you have every year, it adds up over time. So an index fund has 10% turnover, as I mentioned, on average, roughly. If you have a 0.5% increased transaction cost on the sell in the index fund, and then a 0.5% on the subsequent buy that the index fund has to do, that's another 10 basis points, 0.1%. Doesn't sound like a whole lot. You have 0.05% tax on the direct tax of the transaction tax, and you've got another 0.1% in transaction costs. 0.15%, if that's subtracted away from your return as an investor, what happens? If you're saving for retirement and it's 30 years out, you have $10,000 to invest today, and let's say the market returns 9%. You invest that $10,000 at 9% over 30 years, that'll turn into about $132,000. If, on the other hand, it compounds at 8.85%, in other words, just that small 0.15% less over 30 years, you'll have 13% less money when you retire than you would have had without that tax. So all of a sudden, 13% of your potential retirement savings is gone. So this is not a small tax to the average investor. This is a large tax to the average investor. I would point out, this is very small compared to what you would incur in an actively managed fund. 85% of all equity investments in the mutual fund industry are in actively managed funds. Actively managed funds on average turn over 100% a year. The tax, if you just work through the same math, I won't go through it, but the tax would be about the tax itself directly would be about 0.5%. The increased transaction cost would be another 1%. You get a 7% return, 7.5% return instead of 9% return. Over 30 years, your investment would have 1/3 as much money. 2/3 as much. It would have lost 1/3 of its value compared to not having this tax. So again, this hits the individual investor very, very hard. It's not an insignificant amount of money. Ironically, perhaps we'll have time to go into it, I don't believe Wall Street will pay this tax at all. In fact, our increased transaction costs are income to Wall Street. If we have transaction costs, it means somebody else has income. Whose income is that? It's Wall Street's income. With that, I'll stop.